Hello, everyone. Welcome to the CEO and Market Expert interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from X. Today, I'm joined by Bram Vanderelst, head of Curzon Uranium, a company involved in all aspects of uranium trading. Bram, welcome.
Thank you very much. Good to be back on the show.
Yeah, definitely. It has been 6 months since you were in my show. A lot of things have changed in the meantime.
Absolutely.
Uranium price was back then at high 60s. Now it's mid to high 80s, caused by a correction from 106, which was a peak in mid-January. Actually, my first question is related to that. A lot of investors did not quite understand what happened and why did the spot decline at current levels. So, Bram, what happened on the spot market that caused this correction?
Well, I've got that question maybe about 100 times in the last month or so, because nobody really understands, I guess. But well, the first thing and the natural reaction is it's just a normal correction. No market goes up in a straight line. So that's the first thing to know. Like we've gone from high 60s to 107 pretty much in a straight line without very much corrections. So it's a normal correction. But just to unpack it a bit further, we had a really big rally, especially towards the end of the year, in December, and that was a combination of a variety of factors. We saw a bunch of traders and hot money in the spot market, the physical spot market, hedge funds, traders, and the likes, really bidding up the price and not really having any offers or any material that's weighing on the spot price. So essentially, the bidding was really into a void. And then on top of that, in early January, you had the news about Kazatomprom, who are really who have to cut down production because of their sulfuric acid issue in 2024 and possibly in 2025. And so that really got the market spooked and got the market or the bullish investors in a very bullish setup, which meant that more money kind of went into the sector, and also traders all jumped on that news and went long the material. So that's really how we got to 107. How we then came down from there is a different story. Essentially, it's a combination of profit taking, like as simple as that. Traders who were long going into this at 60, 70, 80, $90, they were like looking to get out of this position. And typically in January, February, in the physical market, you see very little action. And that's a function of how, especially the utility, which are the primary buyers work in our sector, they are looking at the new year. They are by definition discretionary buyers. And so they don't necessarily need to step into the spot market in January or February. Then they can probably wait it out later in the year. So what we really saw was utilities that are completely disinterested in the spot market in February, January, March. And that was also a function of the price. It wasn't just purely the seasonality, but it's also a function of the price. When price runs from 60 to 110 almost, utilities are kind of sitting back and saying, well, we don't think this is where the spot price should be, especially given that the long-term price, or at least the reported long-term price, wasn't going up in sync. So utilities had no interest in getting back into the spot market, at least not at those price levels. So that's your primary source of demand that was not available in that time frame. And we saw a similar reaction essentially from traders and producers and hedge funds. So essentially every single entity in the market kind of was going long in the run-up or had no interest in buying. And so essentially when the traders started taking positions or started taking profits, in February, it became almost like a run to the exit, and whoever got out of the exit door first actually managed to capture some of that value, but the rest were all just queuing at the exit with no real bits inside. And that's what happened on the physical market. And then obviously you have the snowball effect with the equity market as well. The equity market had a lot of hot money going into the sector in December of last year. There was a lot of bullish news, and nuclear and uranium was all over the place in the investor space in December and going into January, especially after the Kazatomprom news. And so hot, not so smart money kind of rotated into the sector sector. But then when the thesis didn't play out further along their expectations, and we didn't go to 150 in the next couple of weeks, that hot money started rotating out of the sector, which meant that we saw spot trading at a very, very significant discount, one of the largest discounts we've seen in a while. We saw yellow cake trading at a very significant discount, and we saw the miners basically just trade off completely. And so that then kind of gave a signal to the physical market saying, well, the equity market doesn't believe that the price is correct where it should be. And so the physical traders kind of then went running to that exit even faster, and really trying to find a way to get out of their positions. And essentially what happened is traders were just hitting bids. When a sting bid was put up at like $5 lower than the prevailing spot market at the time, a trader would just hit it because they were just taking profit from a much lower position, and they would hit it with disregard of where the actual price was because they couldn't find any liquidity in the market. And that kind of exacerbated, and we saw that trend play out over the last call it 4 or 5 weeks, until we kind of found what was perceived to be a bit of a bottom around 84, 85. And that's where the natural buyers started showing an interest again. We saw some hedge funds showing an interest in picking up some material again. We saw a couple of utilities that we do know that need to buy, and they saw a $20 drop in the price, so they decided that it might be a good time to pick up. And then you also see the sentiment on the trader side changing again, that maybe we're overcorrected and that nothing's actually really changed on the macro story, and therefore maybe this is a good time to pick up again. So it's just a natural cycle in pricing. Nothing's really changed on the macro story, as I said, but that's kind of where we are in the current setup in the year.
Yeah, excellent points, especially the one that you said it's a healthy correction, and I agree with that. But Bram, during this correction, trading volumes were low, right?
Extremely low.
Yeah, that tells me something else. The market is thin, and this correction was, like you said, it was triggered by a panic of one seller. That's how I see it.
It wasn't necessarily one seller, but you just need to think about it that, especially in the current market setup and where we were 6 to 12 months ago, most traders in our market started realizing this market is only going one way. It's going up because of the macro setup, even though that not all traders do the work, at least not to the extent that we do it at Curzon. But it was very clear that the market was only going one way. And so traders were all going long into the end of the year. But you obviously at some point you need to profit take. There's no point in running a market all the way up and then running it all the way down again. So it was just a bunch of traders who wanted to kind of liquidate their positions that were sitting on large profits, and those traders just couldn't find a buyer, and that kind of was partly timing. It was partly a disinterest by the natural buyers. It was a disinterest by the producers who are short material for 2024, and that's mostly got to do with the timing in the sector, plus obviously then the equity markets that weren't playing ball either. So that's kind of like how to look at this. But as I said, yeah, it's a healthy correction. It's not something that we consider that there's a change in the thesis. So it's a very normal behavior for a hot market that it corrects to the downside.
Yeah, got it. What is the current status as we speak? Who is running the show today, yesterday? Buyers or sellers at the moment?
At the moment, we're back on the seller side. So we see that buyers are starting to pile up now that we've actually reached that bottom, because that's also a feature of our market. When prices trade off or trade up, you see people withdraw their bids or their offers to try to get value, essentially. And we see bouts of real illiquid periods when prices move in one direction, because most entities in our sector that trade are waiting for either the bottom or for the top. And so now we finally found the bottom in the sector at 84, or at least that seems to be the perceived bottom for the time being. We see the bids, so the natural buyers, but also including traders and hedge funds, to get back on the bid side. And now we play the same game, but on the other way around. So now we see the same game being played out where the offers are pretty thin. There's maybe 2, 3, 400,000 pounds waiting on the offer. But beyond that, it's very thin and there's a bit of a void on the upside. And so that's where we currently are. We're currently looking at a market where it's 85 at 86. But if there were to be a few buys, I think we'd probably be back in the 90s very soon. But likewise, we might, like, if for whatever reason there would be somebody coming in on the offer side with large volumes, we could go lower. So I think it ultimately comes down to what we discussed back in September or October last time we spoke, that the market, the physical market, is thin on both sides, and it's very prone to correct and to move in big numbers based on that illiquidity.
Let's put more color on how thin the market is. Let's say I want to secure a larger quantity of uranium on the spot market, for example, 500 million pounds for delivery in 60 to 90 days. Can you give me that?
500 million pounds. That's a bit much. You mean $500 million?
Sorry, yeah.
Yeah, I figured. Could you secure that? It's all price dependent, but no, you couldn't secure it at the current prices. And if you were to put that into the market, we'd be trading above 100 in a couple days again. I always say trading physical uranium is as much trading liquidity as it is trading prices. You need to find the liquidity, and you need to find liquidity when markets are moving. You'll hardly ever be able to trade the bottom or the top because the liquidity usually isn't there. You only have a few trades around the top or the bottom, and then the market starts moving again in the other direction. And so given where the current market is, if you were to deploy that kind of money in the market, we'd be trading up very, very rapidly again. It also depends on how money comes into the market or how money gets pulled out of the market, whether it's in a public manner, whether it's in a more private manner, whether you allow for slippage, whether you have time to sit on a position or build a position. All of these things play a role in how the market reacts. But let's say, for simplicity reason, if Sprott were to raise $500 million tomorrow, the market would be trading well above 100 in the next week.
Yeah, yeah. In your opinion, how much of uranium from spot could be taken by Kazatomprom this year? And the same question, will Cameco take a piece from the spot market as well, which in my opinion, is not so likely. What's your take on this?
Very good question. So to answer that question, you kind of need to look at both of their recent conference calls and their published financials. One thing that was clear on both sides is that they have taken what I call temporary measures in 2023 to deliver into their contracts. Cameco, on one hand, has drawn down inventory, has taken out more loan material, and has moved some of their forward purchase back into 2023. So Cameco has done all three of those, which meant that they didn't have to go into the physical market as much as they would have otherwise in 2023. We expect Cameco to take a similar approach in 2024, which meant that they don't have to go into the physical market too much, maybe to the extent of 1 to 2 million pounds. But those are temporary measures, and those depending on inventory and their forward outlook. If they are confident about their current production rates and they can actually get up to full production, and that forward production rate moving forward is there as well, then I think Cameco might not be in the spot market too much and might try to use those temporary measures to then fill inventory again back in 2025, 2026. But it's very much related to that. But I do think that Cameco will jump in the spot market a bit towards the end of the year. Kazatomprom is a different animal. Same kind of underlying story. You saw that they have they've drawn down their inventories quite significantly last year to what they perceive as comfortable levels, 6 to 7 months forward production, at least on a KP basis. And that doesn't bode well for them, in my opinion. If they really have as many issues as they said and potentially even more, then we expect them to not be able to fulfill all of their contracts in 2024 without dipping into the spot market. However, in their recent call, they said they don't have to, and they're looking at different options. So you need to you need to obviously take that statement at face value for the time being.
Yeah.
But looking into the market, I do think that they might want to come into the market later in the year, depending on also on their contracts. I don't know to what extent their contracts have flex up possibilities. I would expect that any utility with a flexible contract that they can flex up volumes, that they would take that, especially if the pricing is beneficial to them, which means that on the Kazatomprom side, they might not have sight of the full delivered volumes for 2024.
Mm-hmm.
Same with Yellowcake, where is Yellowcake raising another 100 million and buying another million or £1.5 million from them. So those are all uncertainties on the Kazatomprom side. But if you just look at that guidance that they've put forward, they're still making more sales than they have attributable production, sorry, which means by definition that they would either have to dip into their inventory, which is at a multi-year lows already, or they have to dip into the spot market, or find a different solution. Similar to Cameco, maybe they can engage in loans or other manners to get that material. But all of these are temporary measures because loans ultimately need to get repaid. If you pull forward purchase contracts, then that means that you don't have them available anymore when you need them in the future. So all of these are temporary measures that we currently see.
Right. What about term market? How are we looking there? What are you hearing and seeing when it comes to term market agreements?
The term market, we see a big divergence between two sets of players in that term market, or actually three sets of players. But let's focus on the primary producers. We see a big divergence between the existing primary producers and the large entities in our sector, Cameco, Kazatomprom, Orano, who have production, who have shown in the past that they are a reliable producer. And that means that they can demand higher prices and different contract structures. And so we see term prices being fairly high and more weighted towards market linked pricing with a cap and a floor. And as per the Cameco call, that those caps and floors are relatively high with floors around $70-80 and caps into the 100s. But then you have a second part of the primary producer sector, which is the junior sector, greenfield and brownfield production, and they are more looking for fixed price contracts. And they're offering fixed price contracts at a much lower level than what we see the primary producers do. And that's for two reasons. One, you need to convince utilities that it makes sense for them to contract with a junior producer with a greenfield project. Yeah. There's obviously a lot of mining risk, and we've seen that mining risk play out in every part of the world almost in our sector at the moment. Plus, also, a lot of those contracts need to be at fixed prices or at least a portion of fixed prices, because these junior miners need to finance their projects. Yeah. And the best way to finance a project is to get into a debt agreement with a bank or an underwriter. And that debt agreement can only be supported by fixed price contracts, so you can reliably measure your cash flows in the future. So we see junior producers offering relatively or more aggressive prices on that long-term forward basis towards utilities. And those prices are in the 70s, low 80s, which is to a certain extent why the published prices on the term market are in that range. But if you were to purely look at what are the reliable existing producers, that term market price would be much higher than that 70.
Yeah, excellent point. Bram, do you see any risk that utilities will pause term buying in 2024 to cool down the market?
No, I don't think that utilities will really stop buying in the term market. If anything, we see longer and bigger contracts in the term market. The sector really needed to reset on the term market a bit and really get back to replacement rate. And that those are ongoing discussions, and those are discussions that we see being played out at the moment. Where those discussions are going to fall, that's a different question. Yeah. To what extent that utilities can get comfortable with these junior producers, that's a different question. If you're especially for the years that are closer to the current date, so if you're contracting for 26, 27, 28, and even up to 2030, what's your confidence level that when you contract with one of those junior miners, that you're actually going to get it. And if you don't get it, then that means that you're stepping into a market in 26, 27 that might be very tight, and that's prices that are very different than the prices right now because your junior didn't deliver. But that also comes down to how the contract is structured. That liability can be sitting on the producer side or can be sitting on the utility side in a contract. And that's all our contracts are OTC, so I don't have any insight into those. But those are just some considerations on the long-term market.
Yeah, there are risk factors over here. I agree. How is the situation on the market with UF6 conversion and SWU?
With UF6, it's a very tight market because conversion is very tight. Conversion is a pinch point or a bottleneck, I would say, and that's something that we haven't seen being resolved. We see still quite a lot of demand for UF6 and for conversion, and most of the primary producers of conversion not being able to fulfill that demand, or at least being very careful about who they contract with and what to what extent they contract those available volumes. So conversion is very tight, and that as an impact on the UF6. We don't really see a lot of UF6 free available inventory floating around the market, which once upon a time was very different, but right now it's a very tight market. The SWU market, to be honest, is a market that I don't know as well as a natural uranium market, because it's very much heavily dominated by a few large players.
Yeah.
And we don't interact too much with that. We've seen the SMRs market kind of reach a bit of a plateau. Part of that is because we've also seen some SWU from China going into the Western market, which I don't think is a major contributor, but it is, at least on a narrative basis, a contributor to capped SWU prices. SWU contracts are typically much longer contracts, and it takes longer to negotiate those contracts. They're 10, 15-year contracts, and there's a lot of conversation between the primary SWU producers and the utilities going on. But also it allows the SWU producers to commit to building new capacity and to then ultimately fulfill those contracts with new capacity. In the near term, obviously, the SWU market is tight and very much still related to what's happening with Russia. If there will be a ban on Russia and that ban will be fully implemented without the waivers, then the SWU market will be very, very tight, and we'll probably see much higher SWU prices. But that's still to be decided, and that's depending on what happens with that bill that's currently sitting in the US to ban Russian import and potentially retaliation from Russia if there were to be a ban. So that's something to also keep an eye on. But the SWU market is more or less, at least from what I can see, is more or less in the same kind of structure, same kind of pattern that it was back in October when we last spoke.
Yeah, you touched on Russia. Let's discuss the geopolitical side of uranium. What are the implications for the markets if we see a Russian-Ukraine peace deal?
That's a good question. I don't think it will have a major impact on the market. Maybe we'll see some of the immediate risks subdue a bit. So the immediate risk are, on one hand, the transport risk of material from Kazakhstan through Russia, but there's an alternative at the moment to the Trans-Caspian route, which is being developed by Kazatomprom. So that risk is mostly being covered, or at least partly being covered. I would expect that the bill that's currently in Congress and Senate to ban Russian imports would be further delayed, maybe not canceled, but further delayed if there were to be a peace deal. So that might have an impact. But if you look at what's really happening on the ground and what utilities are thinking, no utility, especially in the US, but also in Western Europe or even Eastern Europe, is going to be wanting to be super exposed to Russia going forward anymore. It will relieve some of the immediate pressure, but we won't see a large contracting cycle building towards 10X and Russian-owned entities on UF6 or EUP. That's for sure.
Yeah. What about Russian influence in Africa? Are you following recent developments in Niger?
I am. Niger is obviously an important producing country in uranium, so Niger is a close story to follow up on. From what we hear and see, we don't see the Russian influence being too big in Niger at the moment. It's obviously a story that's been spun in the Western press, and that Russia is supporting the insurrectionists and the junta to get better control over those countries. That's definitely a story that's played out in Mali, if I remember correctly, and in Burkina, but it's less prominent in Niger. Niger is obviously tied in much more with Iran and the French than the other two countries that I mentioned, at least from a uranium production perspective or from a resources production perspective. So we don't really see any real evidence at the moment that Russia is trying to muscle their way into that. Another one to keep an eye on is China, because China has plays an important role in Africa as well. China has historically gone into a lot of African countries on uranium, Namibia being the biggest one. And so we expect China to play a role in Niger at some point as well. But at the moment, we don't see any real evidence that Orano would be leaving the country, or would be asked to leave the country in favor of Russia.
Yeah, as you are a part of WNA working group on supply and demand, you are a perfect guest for my next question. Who will fill the raising supply gap for the uranium in the upcoming years? Could Australia be a deciding factor with the biggest uranium resources in the world?
No, I don't think so, because most of Australian projects are further down the line. Most of the Australian projects are in an early stage.
Yes.
I can't top of my mind, I can't really think of a single one that is that's nearing production, aside from Boss Resources, which is currently in production. But that's a relatively small production scale.
Yeah.
Anything else has been either delayed or is in early phase. For example, the acquisition by DPLO of the Australian asset, that's now their second asset. It's not their flagship, because the flagship is a Namibian asset, which means that, again, Australia will be second in line. And we see similar things happening with the Australian assets owned by Cameco, or the Australian assets in the Northern Territories that are owned by a variety of people. So I don't think Australia is going to be the answer to the big supply gap question. I think if we look at the answer to fill the really widening and big supply gap in the early 2030s or even late 2020s, then we need to look at on one hand the CIS countries, so Kazakhstan and Uzbekistan, increasing production, which is, well, for Kazakhstan and Uzbekistan both the plan, but neither of them are showing a very good track record. And on the other hand, we need to look at the US and Canada, with the US increasing domestic production. Again, they're all very small projects, but we're going to need the aggregation of all those projects to come into the supply stack. Plus, we then need to really have a look at the big projects in Canada. Next gen, Cameco getting them back to full production, and potentially increasing production at McArthur River and Denison. I think those are the three big Canadian ones that you need to look at.
Yeah, definitely. I want to touch a little bit on the future junior producers. One of the segments for your company is financing for junior mining projects in form of equity, debt, offtake, pre-financing, or royalties. Bram, can you please explain in more details how is that working? What kind of companies or projects are you targeting?
I'm not gonna explain too much in detail, because I'm not gonna
No
give you
names,
I'm not
just the
gonna give you the
process.
keys. Yeah, but even the process, I'm not gonna give you the
Oh,
keys to our to what we do. But I'll explain in broad terms.
okay.
Essentially, we as a physical trader, we're always interested in physical material. And so any junior entity or any junior producer that has a view of producing in the near future, we are interested to talk to get some access to material that is currently not available to the market. One is from a geopolitical standpoint, so it's interesting to speak to junior producers that are not geopolitically either relate to Russia or China or elsewhere. And the other is just having access to material. For us as a trader, that's very important, and that allows us to then compete with the primary producers with a book that has a big portfolio of different offtakes and different accesses to material to then offer a more reliable solution to a utility. And to that extent, we engage with juniors on as I said, on financing, on equity financing, debt financing, offtakes, pre-financing. Depends a bit on what the juniors want and what their interest levels are, and what we are willing to offer vis-a-vis the access to material that we can get. But that's about as much detail I'm willing to give.
Fair enough. Fair enough. Enough for me. You are, as we know, you're a partner with Zuri Invest, the Uranium Physical Fund. How is that going? Any change in format or expecting some new services? What's new there?
There's nothing new. That runs as it should be running. So if you look at the price chart on the website, the fund tracks or the AMC tracks the price of uranium very well and very closely. And that was the main reason for the setup, to make sure that there is a vehicle out there for investors to invest that is pure play uranium. And when I say pure play, that's pure play without having exposure to general equity markets and sentiment markets, or sentiment in the general markets. And that's really what they're doing. And so we haven't needed to make any change, or Zuri Invest hasn't needed to make any change, because it's doing what it is. We're still marketing it, so we're still speaking to a lot of investors and banks and the likes about it. It's obviously a vehicle that is that requires a bit more explanation than your traditional Sprott or Yellowcake vehicle, where people can just get into it and with a couple bucks if they want to. And this is more a vehicle that's suited for larger scale investors, but it's working as it should, and it's working really well.
Yeah, maybe there is one new thing I noticed on their website. It's a new section on the Zuri website called stock picking, and it says coming soon. Do you know anything about it?
Yes, but it's got nothing to do with the EMC. So Zuri Invest as an asset manager has been offering stock portfolios for as long as they've existed, which is about 50 years, I think. And so I would imagine that they are looking at more specific uranium, a more specific uranium stock fund as well, in the same kind of vein that that Sprott has their URNM vehicle or something similar, but then with an active management layer on top of it. But it has nothing to do with the structure of the AMC or the AMC itself.
Yeah, I have another question regarding uranium market and selling. What is your view on the potential for uranium to be sold by auction, as just announced by Albemarle for lithium? They have that already in place. Is that an option even for uranium?
I don't know how that will work. So please educate me, and I'm happy to answer the question what I think, but I don't know how that will work.
No, generally, I mean, is there actually an option that uranium can be traded by auction?
I don't see why not. There's no reason why you can't sell uranium via an auction process. Obviously, as long as all the regulatory requirements are in place, as long as contracts have the non-proliferation and peaceful use clauses and everything else. And I would imagine any auction would be only tendered and can be only accessed by pre-approved counterparties who can actually trade uranium. But whether it's an auction or an OTC deal, it shouldn't really matter.
Okay. Bram, final question, SMR market in general, and how is your company involved on the project works for SMRs?
We looked at SMR in quite a lot of detail over the last couple of years. We have engaged with a couple SMRs builds in the UK. We've kind of done a deep dive on the market. And at this stage, I think the SMR market is still quite in an early infancy stage. And quite frankly, I'm not majorly bullish on SMRs. I think SMRs will play a role in the future. Absolutely. Don't get me wrong about that. But I'm not majorly bullish if you compare it to large scale reactors. And I think that's because ultimately, if you if you boil it down to why SMRs are there, it's to solve in my opinion, a non-existent problem. SMRs are there to provide a quicker and cheaper access to nuclear energy than a large-scale reactor could, in theory. But we're kind of making the same mistake with the SMRs than that we have made in the past with the large-scale reactors. We're always trying to improve, get a new design. There's about 50 different competing SMR projects out there at the moment, and SMRs only work if you build them at scale. And essentially that means that you need to pick one or two designs and they take over the world, and you build them at scale in factories and very quickly. But that same equation is true for large-scale reactors. Take an AP1000, which is a very good and very standard third-generation reactor with all the safety requirements that you would require. If the Western world and Westinghouse were to build 10, 20, 30 of those in the next 10 years, you could get that cost of that reactor down to a very competitive cost, and at least at the same level as an SMR could be, especially if you take into account the first of a kind SMR. So in my opinion, it makes more sense for the world to kind of pick a large scale reactor, which got all the economies of scale, and just build a lot of those again. And just take a page out of the Chinese playbook. What we see in China right now with the Hualong 1 reactor, they've got a design that they like, and they're going to be building it. Unfortunately, they're probably going to be building a Hualong 2 reactor, which kind of gets them into the same problem field as we have in the West. But what we really should be doing is just pick a design on a large-scale reactor and build a lot of that, rather than have 20 different or 50 different competing SMR projects.
Yeah.
But I do think that SMRs will play a role, because you do have specific applications where SMRs do make sense. Like if you want to replace an old coal boiler or coal fired power plant, it makes sense to put a equivalent size SMR for like 300 megawatts in there. If you got remote locations where mining sites are very remote or whatever, it makes sense to put an SMR there that's of a lower energy output. You don't need to build a large scale reactor out there. But grid scale, I think it makes much more sense to do large scale reactors than SMRs.
Yeah, I said this is the last one, but I came up with another two. Sorry.
Go ahead.
One question that you probably hate and probably get 10 times a day. Where is the uranium price going, and what are some price predictions for, let's say,
I was surprised that you didn't have that question on your question list. That's a question.
No, really, it just came up. I know you hate it, but people love to.
No, exactly. Like I hate answering it, because ultimately it puts a marker down, and people will always benchmark you against your marker. But I think it's pretty telling. Let's start with that. I think it's pretty telling that the Kazatomprom CEO was adamant in his latest call that he said prices will only move up. Kazatomprom being the Saudi Arabia of the uranium market, I think that should tell something to people. So I kind of subscribe to the same view. Prices still need to move up to fill the supply gap. One, because we see inflation really being playing out on the uranium sector, and those junior projects do need higher prices. And when they needed 70 3 or 4 years ago, they probably now need 80 or 90. And we see that same kind of interaction in at the lower scale, at Kazatomprom's level, at Cameco's level. Production costs just go up. But also we need higher prices to incentivize production to come online quicker, because it's more of a timing issue than a pricing issue, in my opinion. We don't really have a big supply stack between now and 2030 that we can point at and say these projects are really going to fill the gap that is already there, and that's even widening. So yes, I think uranium prices will need to go up. I think prices in the hundreds are healthy. Prices can shoot up to 150 or even beyond that in the next 2-3 years. It obviously depends on a lot of factors and what we see in the market, but it's not inconceivable that it's happening. But I guess without putting a real price out there, I think the answer to your question is yes, I do think prices still need to move up.
Yeah, and this is the final one, uranium equities. What's your take on uranium equities going forward? And are you, Bram, buying uranium stocks? And if you do you like more developers, producers, ETFs? Tell me more.
I shy away from uranium equities mostly, partly because in my job I have obviously inside information to some uranium equities, and so I can't trade them. But more than that, I shy away from them because uranium equity stock picking is quite a difficult process, because at the moment, even more than 6 months ago, but even more than or especially more than 2 or 3 years ago, development is absolutely key, and a route and a story to development. You need to be able to slot your project into the supply stack in the next 5 to 10 years without it being exposed to long-term pricing dynamics. And what I mean with that is that if you don't really have a route to production and a route to production as part of the supply stack at the lower cost base, then I think your project is quite risky. We see a lot of projects. Well, we see plenty of projects or explorers in the Athabasca Basin, but in my opinion, we don't need that many projects in the Athabasca Basin. We need NextGen to come online. We need Denison to come online. We need Cameco to increase their production. We don't need 5 or 6 different juniors all exploring and finding the next Arrow deposit. We need the existing deposits to go into production, because that's what's going to solve the supply gap. And same story in the US, same story elsewhere in the world. It's about going into production right now and capturing the market value that you can find in the next 5 to 10 years. So that's difficult, because every single mining stock has its idiosyncratic risks attached to it. Look at global with the whole Niger risk and the recent announcement between the difficulties between the US and Niger. That tanked the stock 30%, and that has then an onwards effect on whether they can go into production, because financing might be delayed further again. They might not want to come out into the equity market given the current stock price. They need 40% of the financing to be done through equity. So as I said, I'm shying away from equities to a large extent, maybe bar like a Kazatomprom or like some of the larger equities, because they're essentially providing price exposure to the physical market to a large extent. And I think the story, as I said before, the story is really being played out on the physical side, less so on the exploration side.
Good answer. That was Bram Vanderelst. Bram, thank you very much for coming to my show. It was a great chat as always, and we will catch up again sometime soon.
No problem. Welcome, Vivian.